Ind AS 110, consolidated financial statements. It is nothing but accounting for subsidiaries. Under that, first one, procedure for consolidation. There are 5 steps involved in consolidation. Step number 1, calculation of purchase consideration will be done as per Ind AS 103. Step number 2, calculation of identifiable net assets. How to calculate identifiable net assets? As per Ind AS 103, identifiable net assets will be calculated as follows. Fair value of asset as on date of acquisition less fair value of liabilities on date of acquisition will give identifiable net assets as per Ind AS 103. As per Ind AS 110, share capital plus pre-acquisition other equity of subsidiary will give identifiable net assets as per Ind AS 110. Prepare statement of analysis of profit to calculate net assets as on date of acquisition. Step number 3, calculation of non-controlling interest NCA. NCA can be calculated as per Ind AS 103 and Ind AS 110. For Ind AS 103, we can calculate NCA as on date of acquisition. There are two methods, fair value method. Method number 2, proportionate share in net asset method. As per Ind AS 110, we can get non-controlling interest NCA post acquisition as on year end, each year end. How to calculate non-controlling interest post acquisition on each year end? Opening balance as on date of acquisition plus post acquisition share of non-controlling interest in subsidiaries profit minus dividend received from subsidiaries NCA share minus goodwill impairment of goodwill, that is impairment of NCA share of goodwill if goodwill was as per full goodwill method. We will get NCA post acquisition on each year end as per Ind AS 110. Step number 4, calculation of goodwill or gain on bargain purchase. It will be calculated as per Ind AS 103. Step number 5, calculation of consolidated other equity on each year end. How to calculate consolidated other equity? On each year end, parent's other equity plus post acquisition share of parent in subsidiary's profit minus dividend from subsidiary, only parent share will be considered here, minus unrealized profit on downstream transaction plus deferred tax asset on above unrealized profit minus goodwill impairment parent share will be considered. Goodwill as per full goodwill method or partial goodwill method will be considered here. By considering all above points, we will calculate consolidated other equity on each year end. Consolidation entry. If consolidated financial statement is directly prepared without SFS, separate financial statements, then the consolidation entry will be identifiable net assets account debit, to purchase consideration, to non-controlling interest. Balance will be goodwill or gain from bargain purchase. Goodwill means debited, gain from bargain purchase will be credited. Next, if CFS consolidated financial statements is prepared through SFS standalone financial statements or separate financial statements of the parent, in SFS the entry will be investment in subsidiary account debit to purchase consideration. Investment in subsidiary will always be at cost. In CFS consolidated financial statements, the consolidation entry will be identifiable net assets account debit to investment in subsidiary to non-controlling interest to gain from bargain purchase or goodwill. Goodwill will be debited or gain from bargain purchase will be credited. In consolidated financial statements, eliminate investment in subsidiary because we show all assets and liabilities of subsidiary in CFS. Next, statement of net assets, pre-acquisition and post-acquisition other equity. Adjustment list to calculate net assets through analysis of a profit and treatment of post-acquisition profits earned by subsidiary. Particulars: pre-acquisition profit, post-acquisition profit. Other equity of subsidiary. Opening balance of other equity of subsidiary will be considered under pre-acquisition profit column. and profit during the year will be considered under post-acquisition profit column. Add dividend paid by subsidiary. 100% dividend, 100% subsidiary. It will be considered under post-acquisition profit column. We will calculate evenly accrued profit, both in case of pre-acquisition profit and post-acquisition profit. Plus or minus time adjustment will be done. Deduct from post-acquisition profit and add to pre-acquisition profit. Dividend paid by subsidiary. Dividend paid by subsidiary will be deducted from non-controlling interest share under step 3 and parent share in step 5. That is, step 5 means consolidated other equity. Plus a revaluation gain on non-depreciable asset. It will be considered under pre-acquisition profit column minus deferred tax liability on revaluation gain on non-depreciable asset. It will be deducted minus revaluation loss on non-depreciable asset. It will be deducted. It will be considered under pre-acquisition profit column. Add deferred tax asset on above. Add revaluation gain on depreciable asset. It will be considered under pre-acquisition profit column minus deferred tax liability on revaluation gain on depreciable asset minus additional depreciation due to revaluation gain on depreciable asset. It will be considered under post-acquisition profit column. We will minus it plus deferred tax liability reversal due to additional depreciation minus revaluation loss on depreciable asset. It will be deducted from pre-acquisition profit column. Add deferred tax asset on above. Deferred tax asset on revaluation loss on depreciable asset. It will be considered under pre-acquisition profit column. Next, add savings in depreciation due to a revaluation loss on depreciable asset. It will be considered under post-acquisition profit column minus deferred tax asset reversal due to savings in depreciation. It will be deducted. Next, add revaluation gain on current assets or current liabilities. Example, inventory, trade payables, trade receivables, investments minus deferred tax liability on above. This will be considered under pre-acquisition profit column. Less reversal of revaluation gain on current assets or current liabilities only if they were sold or settled during the year. It will be considered under post-acquisition profit column. Add deferred tax liability reversal on above under post-acquisition profit column minus revaluation loss on current assets or current liabilities. It will be considered under pre-acquisition profit column. Add deferred tax asset on above under pre-acquisition profit column. Add reversal of revaluation loss on current assets or current liabilities only if they were sold or settled during the year. It will be considered under post-acquisition profit column minus deferred tax asset reversal on above. It will be considered under post-acquisition profit column minus unrealized profit on upstream transaction will be considered under post-acquisition profit column minus deferred tax asset on above. It will be considered under post-acquisition profit column. Total the pre-acquisition profit column and post-acquisition profit column. Pre-acquisition profit column will be considered as identifiable net assets and post-acquisition profit will be allocated to parent and non-controlling interest. Adjustment list of analysis of profit. Assumption that profits have evenly accrued throughout the year. When acquisition is made during the year, assume that profits have accrued evenly throughout the year and disclose this assumption in your solution. When opening balance of other equity of subsidiary is missing, in case of retained earnings, assume opening to be zero and hence full balance was earned during the year. In case of other reserves, assume opening balance to be same as closing balance. Dividend received from subsidiary. In CFS of parent as per Ind AS 110, dividend has been declared by subsidiary and hence has been deducted from current year profit of subsidiary. Hence the following adjustment is required. Add back dividend to post-acquisition profit before time adjustment. Deduct dividend proportionately. In case of parent share, deduct from consolidated other equity In case of NCI share, deduct from non-controlling interest NCI. Effect of revaluation of identifiable net assets. In case of revaluation of non-current assets, that is PB, property, plant and equipment, when the fair value of identifiable net assets is different from the book value of the asset, then property, plant and equipment. If property, plant and equipment is depreciable asset, calculate revaluation gain or loss on date of acquisition along with its tax effect, that is DTA, DTL. This shall be adjusted in pre-acquisition profit of the subsidiary. Calculate additional or savings in depreciation due to revaluation of assets. It shall be adjusted in post-acquisition profit along with its tax effect. If PP is non-depreciable asset, calculate revaluation gain or revaluation loss on date of acquisition along with its tax effect, that is DTA or DTL. This shall be adjusted in pre-acquisition profit of the subsidiary. Next, in case of revaluation of assets and liabilities other than PP, property, plant and equipment, example debtors, creditors, inventory, investments, calculate revaluation gain or loss as on date of acquisition along with its tax effect, that is DTA or DTL. This shall be adjusted in pre-acquisition profit of the subsidiary. If such assets and liabilities are realized or settled during post-acquisition period, reverse the gain and respect to DTL or loss and respect to DTA from post-acquisition profit. If such assets and liabilities are not realized or settled during post-acquisition period, that is outstanding on balance sheet date, no need to reverse the effect. In the absence of any information, we shall assume that such assets and liabilities are outstanding on balance sheet date. Next, unrealized profit on intercompany transactions, that is on sale of inventory or transfer of non-current assets. If the date of transaction between the companies is before the date of acquisition, no need to eliminate the unrealized profit, ignore such transaction. If the date of transaction is after the date of acquisition, calculate the amount of unrealized profit, calculate only when inventory or asset is outstanding as on balance sheet date. Unrealized profit. In case of upstream transaction means sale by subsidiary to the parent. Journal entry for elimination of unrealized profit in CFS is P&L account debit to inventory or asset of the parent account. P&L account post acquisition of the subsidiary. Post acquisition profit should be considered. In case of downstream transaction, downstream means sale by parent to the subsidiary. The journal entry for elimination of unrealized profit in CFS entry will be P&L account debit to inventory or asset of the subsidiary. P&L means parents consolidated other equity. Next, due to reduction in carrying amount of inventory or asset, tax base may be different from carrying amount. As the above unrealized profit elimination is done only as per accounts, therefore create DTA or DTL. DTA or DTL on unrealized profit in case of upstream transaction. Journal entry for DTA, deferred tax asset in CFS is DTA account debit in CFS to P&L account, that is post acquisition profit of the subsidiary. In case of downstream transaction, journal entry for DTA is in CFS DTA account debit in CFS to P&L account, parents consolidated other equity. The above provisions of unrealized profit are applicable only when inventory or asset is outstanding on the balance sheet date. If the inventory is sold to outsider before the balance sheet date, then no need to reverse any unrealized profit. Summary of intragroup sale and purchase elimination and unrealized profit elimination. First one, whether to eliminate intragroup sale and purchase. In case date of transaction is before date of acquisition, no need to eliminate. In case date of transaction is after date of acquisition and inventory is outstanding at the year end, we need to eliminate full intragroup sale and purchase. In case date of transaction is after date of acquisition and inventory sold is full, we need to eliminate the full intragroup sale and purchase transaction. In case date of transaction is after the date of acquisition and inventory is partly outstanding, we need to eliminate full intragroup sale and purchase. Second one, whether to eliminate unrealized profit. In case date of transaction is before the date of acquisition, no need to eliminate the unrealized profit. In case date of transaction is after the date of acquisition and inventory is outstanding at the year end, we need to eliminate the unrealized profit. In case date of transaction is after the date of acquisition and inventory sold is full, that is 100% inventory sold, then no need to eliminate the unrealized profit. In case date of transaction is after the date of acquisition and inventory is partly outstanding, then we need to eliminate unrealized profit only to the extent of partly outstanding part. Next, preparation of consolidated balance sheet. Assets and liabilities. Assets and outside liabilities of the subsidiary company are combined with those of the parent company. Effects of appropriate intragroup elimination adjustments are given. The equity share capital of the subsidiary and the investment of the parent company in subsidiary are eliminated, and goodwill or capital reserve and non-controlling interest are recognized. The parent share in post-acquisition profits of the subsidiary company added to the appropriate concerned account of the parent company are accounted in consolidated balance sheet.